internationally, Guernsey, Dubai, Geneva. Although I suspect you won't be able to really read that. Just a quick whistle-stop tour of the main headings in terms of the criteria for each of the investment reliefs. It's very generous what the government have actually introduced in terms of EIS and SEIS. It motivates you as investors to take up investment in what might be considered to be the most risky end of the investment spectrum. The limits are per investor, 1 million for EIS, 100,000 for SEIS. The tax reliefs, 30% and 50%. You have a period that you have to hold your investment for 3 years. If anything happens, including disqualifying events, there may be a tax clawback within that period of time. You can use this relief and investment strategy to roll up gains from previous investments. So you can do CGT rollover. Unlike VCTs, the dividends that you receive from an EIS or SEIS company are not free of tax, but they are free of capital gains in due course when you come to sell. You can get loss relief, so if the most unfortunate circumstances happen and the investment fails, you can get tax relief on your investment, and it is part of the IHT planning, so it's available. You can get business property relief or similar. Most of the rest of the slides are relating to the general EIS and SEIS. There are different rules and regulations for those that are considered to be technology companies. So the criteria for the various companies are that in terms of balance sheet, you have to have gross assets of less than 15 million for EIS and less than 200,000 for SEIS. Less than 250 employees and less than 25 for SEIS. The maximum investment that you can raise in any one tranche is 5 million for EIS and a total of 150,000 for SEIS. Overall, the maximum investment that you can get for EIS is actually 12 million or 20 million if you're knowledge intensive. And you can do that in stages. What I actually thought would be more interesting to you as investors is actually the pitfalls that can commonly occur when you're investing. You put your money in and then you actually find that for whatever reason there's been a glitch and actually you don't get your it doesn't qualify for the reliefs. So I've tried to order these in most common occurrence, and the most common one is actually that you actually do, or the investing company is raising so much funding that it runs through the EIS limit of 150,000 and then into EIS, and unfortunately money's taken on the same day, and by doing so that will actually breach the rules and you won't qualify that way for your EIS. So for the investor, you have to make sure that basically it's at least a day apart. It's a safe bet. Often money can be promised but not actually delivered to the company's bank account, and again, the whole premise of the EIS and SEIS rules is that it's an investment for cash. So if there's any delay, that can cause issue. The shares have to be what we would normally class as ordinary shares, i.e. they're full risk, they don't have any preferential rights to dividends or return of capital in the event of liquidation or sale. You would also have to have no substantial interest in the business, which means that any holding in excess of 30%, you would then breach the rules and you will fall out of the EIS regime. Employment, you can be a director but not an employee of the company. One that's often sort of below the radar is that if you have two investors, one will actually say, well, you invest in my company, I'll make a similar investment in your company, we both then benefit from the EIS regime. So somebody smiling there. That is obviously not allowed, and if you're caught, it'll effectively remove the release for both of you. Another common thing is where people have made loans to the company, and there is a specific arrangement whereby you're not supposed to have anything, they call it returns of value. So if you make loans to a company in which you invest, normally during that 3-year period we would say, you know, you don't have the loans repaid for any reason during that period. Afterwards it's okay, but during that period you would leave them alone. You have to have a qualifying SEIS or EIS company. Most of the pitch presenters tonight will tell you that they've gained advanced assurance so that you are secure in the knowledge that those particular investments are qualifying, but they are subject to being trading companies, and there are excluded activities which would not qualify. Those include investment in nursing homes, banking on money lending arrangements and such like. Excuse me. Control. Whenever you're making an investment, always look to invest in topco. Any investment in a subsidiary will automatically not be an EIS or EIS investment. Administration, the submission of the EIS 1 form, which is to notify HMRC that you've made an investment, is usually done after 4 months of trading or when 70% of the investment is spent. So there can be a time delay between you investing and sort of the paperwork coming through. VCTs can be even worse, because if you invest a lump sum and that goes to various companies, it will be a period of time when all of the paperwork comes through. So you'll have to watch that when you're applying for tax reliefs and putting the entries into your self-assessment return. EIS, your first investment has to be within 7 years, and usually that's from the date of the first commercial sale. The one pitfall here is that if you've acquired a trade, so you've acquired it from another entity, or indeed you're now the top co of a subsidiary, that subsidiary carried on the trade before that 7-year period, that would again be a breach of the rules and you wouldn't get your own either SEIS or EIS relief. Interesting to note that you can get SEIS or EIS for non-UK companies. The only criteria is that they have to have a UK branch, so effectively they operate within the UK. Having a sub in the UK is not the same thing. It has to be the top co that has the branch, and if you do have it where there is a branch, the business has to be separate and identifiable from a UK sub. One other thing is, because this is called state aid under the old EU legislation, you have to watch the 5 million that, if any of you do invest 5 million towards a combined group, if there is any currency movement, you can actually breach the threshold by virtue of what would be an exchange gain. Don't know how we do for time.
Just over 8 minutes.
In terms of Saffery Champness, as we said, top 20 firm, we actually have international links across the globe with our group, which is Nexia International. So if you actually want any investment advice or advice on your investments for tax purposes, we can cover not only Europe, America, Australia, and that's sort of it. I think I've raced through that. So if there are any questions, happy to sort of build something out for you.
Okay, thank you very much, Mark. In fact, if there's any questions, maybe ask them over dinner. It's probably going to be the easiest solution to that. So thanks. Round of applause, please, for Mark.